This is a lecture from OpenTuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
Chapter 24 deals with inheritance tax, as we see here, and just as with many of the more recent chapters within our study notes, we will be combining both newly recorded lectures using the FA2019 material and also dipping into FA2017 lectures. There has been only one change since FA2017 as regards one specific technical area. But because dates are so relevant in terms of the examples that we do within this chapter, the vast majority of those examples we've re-recorded the lectures, so you will be using the dates relevant within the FA2019 material. What you must do, as you have done over those recent lectures, basically since chapter 18, we've been combining both FA 2017 old lectures with the FA 2019 recorded material and study notes. You will have seen that prior to each opening and accessing each lecture, there are some written notes explaining what it is that is different, whether indeed it simply is a newly recorded lecture for you, and therefore you can crack straight into that, or whether indeed it is an FA 2017 old lecture that we are using, and if there are any differences in terms of what's in the study notes between what you are looking at in FA 2019 study notes and what's used in the lecture, FA 2017, I will identify what those differences are. Most of the differences in the previous chapters, as you've seen recently, is to do with dates and examples. And as I've just said, most of the examples that we've got within this chapter, I have newly recorded the answers to them using the FA 2019 material, so as hopefully to avoid any confusion there. But again, prior to each of, and this is a huge chapter indeed, is chapter 24. It comprises about 8 or I think 9 lectures that we have here. It is a huge chapter, but prior to each of those lectures, just glance through, have a look at the notes, identifying which material is being used, and if it is FA 2017 material that we are using, what the issues are, if any, as regards the use of that material and its relevance to the current day. In terms of inheritance tax, it is the second of our 2 capital taxes. We've seen the first capital tax, CGT, and now we come to IHT. Now again, I won't spoil the technical content of the first lecture for you, coming up in but a moment's time there. But in relation to the capital taxes, we know that in our examination, we're going to face in section B, basically 3 10-mark questions that will look at the, we call them the non-main taxes. Section C is 15-mark income tax, 15-mark corporate tax. There's a 10-mark question. Again, I'll refer to that in a moment. Section B is where we see the main other taxes. So we're going to have a 10-mark CGT question. Obviously, each is 5 2-mark objective testing exercises based on a scenario situation, rather than section A, where it's an individual point with an individual question, scenario, and then 5 specific objective testing questions, testing you on individual points within that scenario. And you can see that for CGT, and you're also going to see that for IHT. Now, these capital taxes will also have a presence within section A. Again, probably 2 or 3 questions on each of those 2 taxes within section A. And a possibility, going back now to section C, that the 10-mark exercise, which tends to be, as we've said many times before, a tax planning based exercise, may well involve both of the capital taxes, both CGT and IHT. Because what you've discovered already in capital gains tax is that if you give something away in lifetime, and if there is a donative intent, you haven't just done a bad deal, then if you do that for CGT purposes represents a chargeable disposal. And if it's a chargeable asset, you are a chargeable person, then you've got to calculate capital gain based on open market value. But when we give things away in lifetime, what you'll discover in, indeed, the introduction to the very first lecture you'll be seeing, again in just a few moments, that where there are lifetime gifts, they may eventually be chargeable to IHT. So what you might get is arising out of a single transaction, a taxpayer gifts an asset to another taxpayer. Commonly, a parent makes the gift of an asset a chargeable asset to their son or daughter. What you have is both an immediate CGT implication and a capital gain to compute based on market value, and the possibility at that point in time of a further IHT liability that may arise. Now, what is the point at which an IHT liability is most likely to arise? Sad to say, the death of the taxpayer. So in Section C, you could get a little 10-mark written exercise that asks you to advise about the tax implications of making certain gifts of certain assets in lifetime. And what that would mean is that you would have to consider, in turn, each of the capital taxes. CGT, that you should already know about and be able to deal with. Is it a capital gain, first of all, the gift? Do you have a chargeable disposal? Yes, we do. Is it a chargeable asset? If it's not a chargeable asset, if it's exempt, then there is no capital gain. But otherwise, there is a gain to compute, based, as we've just said, on market value there. But depending on what the asset is, you may recall gift relief. Gift relief might be available. If it is available, we have to state that and what would happen as a result of the gift relief. And in relation to that same gift, to say that in lifetime, there would be no immediate IHT liability. And then, based on what you're about to do in Chapter 24, you would also have to consider the inheritance tax implications. Now, that's a planning overview that I've very quickly given to you there. And obviously, you need to have the technical knowledge that underpins CGT, that you should already have, and IHT, that you're about to get here. And in Chapter 26, the Tax Planning Star Questions chapter, the notes bring that together to explain to you how, with examples, we might face a particular Section C question that asks just that very question I've posed there, to advise a taxpayer over the tax implications of making certain gifts in lifetime, where, as we've said, both capital taxes need to be considered. The immediate issue of CGT and, as we'll come to note, the potential future issue of IHT. Okay, again, remember, prior to each of the lectures, review through the notes that precede that particular lecture to make sure if it is an FA 2017 lecture, you know what the issues, if any, are prior to watching that lecture. I look forward to seeing you. Well, I think lecture 1 is indeed the first lecture is going to be from FA 2017. So, yeah, I don't think you can see me on those, but at least you can listen to me with a 2-year-old voice. But everything that I say in that lecture is still relevant. Okay, enjoy IHT. Someone once said, probably wise but very depressing person, that there are only 2 certainties in life. They are death and taxes. Well, here in Chapter 24, we get to combine those 2 things together, because it is usually just one occasion where an individual will fall foul of the inheritance tax system and chargeability to IHT will arise. And that one occasion is when they die. But when they do die, it doesn't necessarily mean that all of their so-called chargeable estate will be subject to inheritance tax. Because what we have in inheritance tax is, to begin with, a very pleasant rate of taxation. A nil rate band. Currently, and that's a big number, £325,000. So if anybody dies with a chargeable estate of no more than £325,000, although it is chargeable, it'll all be charged at a nil rate. There will be no tax to pay. Now, we have said that this is going to be chargeable on, and a very appropriate name, of course, the chargeable estate. That chargeable estate, it's like a little balance sheet that we prepare for the individual on the date of their death, listing out all the assets that they held at the date of death, and of course deducting from it any debts or liabilities that may be due. And on that net value of the chargeable estate, we then proceed to charge inheritance tax at, as we'll discover, two rates. Either, if we are within the nil rate band, the nil rate, as we can see currently there, and it has been so for many years, as we'll witness in later examples, £325,000. But it goes from a very pleasant rate of taxation, nil rate, to a rather harsher level, because anything over the nil rate band is going to be taxed at 40%. Now that's a huge rate of taxation that we're talking in terms of. It is why, of course, that as there are these two certainties in life, death and taxation, yep, we're all going to die, that those with estates, well, probably significantly in excess of 325, would need to try to plan, if they could, to seek to be able to avoid what was the otherwise inevitable tax charge of 40% on the excess of their chargeable estate over the available nil rate band, currently, as we've said, £325,000. 40% is a lot of tax to pay. So you imagine someone with an estate of, let's say, a chargeable estate of 525. Now, the nil rate band is 325, so I'm picking 525, not as exactly a random number there, but if you've got 525, 325 is at nil. What's the excess? 200,000 from 325 up to 525. And that 200,000 will be taxed at 40%. That is £80,000 of tax on that chargeable estate of 525. So anything over and above 325, to lose 40% of that is a huge chunk of your estate going to Her Majesty's Revenue and Customs, probably rather than to your nearest and dearest, your kids, your grandchildren, etc. Now, of course, you might be thinking that, and very right, might I add, that your nearest and dearest would be your spouse. But as we'll discover just a little bit later, we don't have to worry about when assets transfer to our spouse or civil partner, because all transfers between spouses are exempt IHT. The idea of inheritance tax is when assets pass from one generation to another, rather than spouse to spouse there, or civil partner to civil partner. So there would be no taxation, but as soon as you start to drop a generation or two, that's when we have this 40% tax rate coming in on chargeable estates whose values exceed that nil rate band, currently 325. Now, an important issue here. If it was only the assets that we still owned at the time of death, if only those were to be taxable, this sort of colloquial expression known as deathbed gifting, there's a lovely little title, deathbed gifting, i.e. giving assets away just prior to death, if of course you knew that you were not much longer for this world, all you would have to do is to, if I've got a 1.325 million estate, 1.325 million, I give away £1 million while I'm still alive. That leaves me with only 325, covered by my nil rate band. I wouldn't pay any tax. It's way too easy to be able to avoid IHT. So what this means is that not only when you die will the content of your chargeable estate, what you still own at the date of death, not only will that be subject to IHT, but what will firstly be subject to IHT is lifetime transfers that you made. But of course, there's the question of how far back do we go in terms of those lifetime transfers? This deathbed gifting, do we only go back 7 minutes, 7 hours, 7 days? You might see where this is going. 7 weeks, do we go back 7 months? But no, we go back 7 years. So that lifetime gifts, those made within the 7 years of death, will also become chargeable on the death of the taxpayer. So, when a taxpayer dies, there will be 2 IHT computations that need to be prepared. The first, all of which of course we'll see later, the first of which would be listing out those lifetime transfers that were made within the 7 years before death. Anything that's more than 7 years before death will not then be taxed as a result of the death of the taxpayer. Only those transfers made within the 7 years before death will actually be chargeable as a result of your death. So those will be taxed first, and in order, the oldest first. So if I've made a lifetime transfer or lifetime transfers 6 years ago, 4 years ago, 2 years ago, their first to be charged would be the one made 6 years ago, followed by 4 years ago, followed by 2 years ago. And only when those transfers have been charged to IHT, using again, and I'll come back to this in a moment, our nil rate band of 325, only after the lifetime transfers have been charged would we then tax the chargeable estate. Now what that means is, if your lifetime transfers exceed 325,000, then it is they that will enjoy the use of the nil rate band. Very good news for those who were gifted those particular assets within the lifetime of the 7 years of the lifetime tax, 7 years of the death of the taxpayer, who now, sadly, of course, has died. It is they, the recipients of the lifetime transfers, who will benefit from that nil rate band. And in order. So the first transfer 6 years ago is the first to enjoy the nil rate band, followed by the one 4 years ago, followed by the one 2 years ago. If that is used up, as we said, all of the nil rate band, then all of the chargeable estate would be taxed at 40%. So, 2 IHT computations to prepare on death. Firstly, the lifetime transfers made within the 7 years of death now becoming chargeable on death. It is they that will use up any available nil rate band. Followed by then the second computation, the chargeable estate at death, to begin with, very simple, a listing exercise. Listing out, as we said, all the assets held by the taxpayer at the date of death, taking out any debts and liabilities due. Having got the chargeable estate, have we as yet used up all of the nil rate band on those lifetime transfers? If not, whatever is left over, that will be applied first, and then the balance will be chargeable then at 40%. Now, very specifically, those lifetime transfers, when we make a gift in lifetime, we have to know how to calculate the amount of transfer, the chargeable transfer figure. And what we have to now look at is something called a transfer of value, a transfer of value. IHT is said to be, and this makes it very different to other taxes, it is a cumulative donor-based tax. Now, normally, the amount of tax that an individual will pay will be payable on what they have, what cash they've received, what income they have, what capital gains they have. They have income chargeable to income tax. They have received sales proceeds on the disposal of an asset. They've made a capital gain. So the tax is always on the recipient of the income, the recipient of that gain. But here, IHT is a cumulative donor-based tax. And for it to arise, an individual must make a transfer of value, i.e. a gift, computed as the loss to the estate of the donor. And what that basically means is the difference in the estate value before and after the gift of the asset. So, cumulative donor-based tax. The amount of any tax that may be payable on any transfer is nothing to do with the recipient, it is everything to do with the donor. Now that's specifically relevant re the use of the nil rate band. As we've just said, and we're going to see very soon an example that will illustrate this, that if I make a transfer 6 years before I die of £200,000, that will be covered by the nil rate band. So the recipient of that 200,000 will have no tax to pay. But then I make a gift to another person 4 years before I die. Now then, it's a cumulative donor-based tax. So I've already used up 200,000 of my nil rate band. Out of 325, there's only 125,000 left. So the second transfer only gets 125,000 nil rate band, and 75,000 of the 200,000 gift is then at 40%. And then I do another 200,000 gift 2 years before I die. Well, my cumulative total so far in the 7 years before death, 200 plus 200 is 400. So that's used up all of the nil rate band. So the next 200 is going to be fully taxed. 3 different people, maybe my 3 kids there, are given £200,000 to gift 1 6 years ago, gift 2 4 years ago, and gift 3 2 years ago. And what happens, therefore, different amounts of tax are payable. The first gift of 200,000, no tax because it uses up the nil rate band. The third gift, all of the 200,000 is taxable at 40% because by then the nil rate band has been fully used. So it is a cumulative donor-based tax. It has nothing to do with the donee, the person receiving the gift. Each of my 3 kids there has received, before taxation, a gift from me of £200,000. And yet the amount of tax that then falls due, sadly, as a result of my death within 7 years of making each of those gifts, the amount of tax is very different. All of which computations, don't worry, we will see in these further notes. So IHT, cumulative donor-based tax. Nothing to do with the personal circumstances of the recipient, the donee. The amount of tax has got everything to do with the circumstances of the donor and how many cumulative transfers have been made. Here, at this point anyway, in the 7 years before death. But I just gave you a figure of £200,000 as the transfer of value. We've actually got to work that out ourselves. Now, again, it is, as we say here, the difference between the value of the estate before the transfer and the value of the estate after the transfer, after the asset has been gifted. Now, in most cases, it's a very obvious figure. The transfer of value will equal the market value of the asset being gifted. Again, as we suggest here, I give away cash of £100,000. I had cash of £100,000 before the transfer. I haven't got it afterwards. It's very clearly £100,000. I give away a property worth £250,000. I had the property before the transfer. I don't have the property after the transfer. The transfer of value, that difference between before and after, clearly £250,000 there. As we've said, the amount of tax that may be payable on a transfer of value is based on the cumulative amount of transfers made by the donor over a 7-year period. In relation to what is chargeable on death, that is going to be the 7 years before death. Though be aware that although at the moment, and all we will talk about at the moment, is the main occasion of chargeability to IHT, the death of the taxpayer, where we have acknowledged that there are 2 computations required. 1, lifetime transfers chargeable on death, i.e. those made within the 7 years of death. And the second computation, the chargeable estate at the date of death, that listing out of the assets less the liabilities of the taxpayer at the date of death. But in addition, there are also some transfers made in lifetime, transfers into trusts, don't be put off by that word, we'll explain that later, that would generate immediate chargeability to IHT, as well as chargeability on death, that is, if you die within 7 years of having made them. Now, don't worry about these chargeable lifetime transfers, these lifetime transfers into trust. Don't worry about those at the moment. We're going to look at the main circumstance of the vast majority of UK taxpayers to begin with, who do not spend their time in lifetime making transfers of cash or other assets into trusts. If they're going to make a lifetime transfer, it's going to be to another individual. That individual, usually in exam terms, is someone other than your spouse. Remember, transfers between spouses are exempt. Most likely son, daughter, nieces, nephews, grandchildren there. And when such gifts are made in lifetime, there is no immediate chargeability, only where we have transfers into trust. But it does set up the situation that by the end of this chapter, we're going to have to be able to deal with in lifetime, immediate chargeability to IHT only if we've made transfers into trusts. If then you have died within 7 years of having made either transfers into trusts or to other individuals other than your spouse, they now become chargeable on death. Therefore, we need to be able to compute the IHT on such transfers. And finally, the chargeable estate at death, as we keep saying, just that listing exercise of what you held at the date of death, less any debts and liabilities due at the date of death. Now then, to come back to this transfer of value, usually it's just the market value of what is being gifted there. That's the usual situation. The cash of 100,000, the property worth 250,000 there. But with certain assets, and most notable of all, shares in unquoted companies, the transfer of value may be considerably higher than merely the market value of the asset being gifted. We've got to measure it as the difference between what the taxpayer had before the transfer and what he had after the transfer. And the reason why this is the case is when we look at unquoted shares, there is no single share price that will apply to all shareholdings. If you have shares in an unquoted company, the value per share is a function of the level of shareholding that the taxpayer has. The bigger the shareholding, the greater the degree of control that person has over the company, then the higher value, the higher price per share that will exist. Again, if, for example, if you were offered a 1% interest in an unquoted company, where the other 99% is owned by various members of the same family, not yours, would you be interested in buying into that 1% interest? Answer, no. Who wants it? What can you do with that 1%? You can have got no degree of control. Something is worth only as much as somebody is willing to pay for it. That 1% would have a very, very low price per share. But what about if you were offered 51% of that company? Would you be interested in that? Oh yeah, if you've got 51%, then you control that company. Therefore, the value of a 51% interest in the company, do you think that that is 51 times what is the value of a 1% interest in that company? I don't think so. It's got to be hugely greater than that. Now, again, at the end of the day, you don't have to here wonder about how these share values will come about. All you've got to do is use the information in the question to compute the required transfer of value. So we've got an example here. A owns 60% of the shares in A Limited. A Limited has 100,000 £1 ordinary shares in issue. So A has got 60,000 shares. He's got 60% of the 100,000. And then we see what would be said to be agreed share valuations with HMRC at different levels of shareholding, starting at a 20% shareholding where it's merely £10 per share, and going up to 80% where you have absolute control. You got more than 75%, you remember from your company law there, that can give you effectively absolute control. That if you've got 80%, it's then £40 per share. And in between, as again the shareholding go up to 40, to 60, eventually to 80, so too does the share price go up, from £10 per share to 15 to 25 to £40 per share. Now, you don't have to wonder where they come from. What we've got to be able to do is to use them to compute this transfer of value. So we've got to compute the transfer of value now in two circumstances. If A were to die, leaving his shares to his daughter. Right. Sadly, if A dies, he leaves all of his shares, that is 60,000 shares, there to his daughter. 60,000 shares, as we know, is a 60% interest. What is the price per share? It is £25 per share. So if A died owning his 60,000 shares. That 60% shareholding, they'd be valued at £25 per share. 60,000 shares at £25, a value of 1.5 million would be listed regarding those shares within the chargeable estate at death. That's an easy calculation, because when you die, the transfer of value, remember, the difference between what you had before the transfer and after the transfer is a very simple one. Before the transfer, before the date of death, he owned 60,000 shares. As a result of death, he owns nothing after that. They've all gone to the beneficiary. So the before and after is the entire shareholding there, the 60,000 shares. What is way more interesting is where we have a lifetime transfer. And it's here that it would be tested in terms of your exam, almost certainly. So here, alternatively, if A were to make a lifetime gift of 20,000 shares to his daughter, how do we value that for purposes of inheritance tax? Right. It says here, if you were to give 20,000 shares in lifetime transfer, the transfer of value would not be based on the value of a 20% interest, i.e. £10 per share, because we're not valuing what is being transferred. For IHT purposes, we are taking the difference in value between what the taxpayer had before the transfer, which here is 60,000 shares, before 60,000 shares, that is a 60% interest, that would be valued at £25. As we see, if he died owning those shares, they'd be worth 1.5 million. So before the transfer, he owned 60,000 shares, that's a 60% interest, and they're valued at £25 a share. After the transfer, he's given away 20,000, he's got 40,000 shares. That is a 40% interest. A 40% interest, therefore, has a price of £15 per share. 40%, 15. 40 times 15, 600,000. £900,000 is therefore the transfer of value. Now that is a darn sight higher than the market value of the asset being gifted. The market value of the asset being gifted, that was 20,000 shares, that was valued at £10 times £10, that would be £200,000. Look at the difference. The market value of what has been gifted, 20,000 shares, is 200,000. But for IHT purposes, the transfer of value is the difference between what the taxpayer had before the transfer and what he has after the transfer. And that is a whopping great big £900,000 figure. Now, here we're dealing with IHT. But when you come to Chapter 26, we'll talk about tax planning situations that are now venturing into our F6 examination. And what you might have to discuss and advise a taxpayer about in their lifetime are the tax consequences of gifting 20,000 shares in the company here, A Limited, to his daughter. And what we would then be able to deal with is not just one tax, but two. Both, as they're known, capital taxes, CGT and IHT here would be involved. We're looking at IHT now, so let's just remind ourselves what we have. For IHT, we have a transfer of value made in lifetime that amounts to £900,000. At that point in time, there'd be no chargeability to IHT. It would only become chargeable to IHT if he dies within, what was the period? 7 years. If he does die within 7 years, the transfer of value becoming chargeable to IHT is £900,000. But that will only happen if he dies within 7 years. Live for more than 7 years, there'll be no such IHT charge. But at the time the gift was made, he gave away 20,000 shares there to his daughter. CGT is involved. Capital gains tax, remember, arises where there is a chargeable disposal of a chargeable asset by a chargeable person. That was the basic definition that gave rise to chargeability to CGT. And we learnt at that point in time that a gift represents a chargeable disposal. Chargeable disposal doesn't just occur for CGT purposes when you sell something, but also when you give it away. And if you make a gift in lifetime, what therefore do you use as the basis for calculating your gain? You use the market value of the asset being gifted. So for CGT purposes here, the asset being gifted is 20,000 shares. How do we value 20,000 shares, i.e. a 20% interest in the company? At £10. That therefore would give you a disposal consideration for CGT purposes of £200,000. So that would feed into a capital gains tax calculation. Now, I don't know how much of your CGT you now remember, but this is when life gets really interesting in terms of a scenario, what is now a multi-tax scenario. Both capital taxes are involved, because at the time you made the gift, something you're used to from CGT, a gift is a chargeable disposal, a capital gain is computed based on market value, the market value is 200,000, take away the cost, and you've got the chargeable gain. Will that chargeable gain then be subject to tax? Well, it's possible that it may. It's equally possible that it may not. Because depending on what type of asset is being gifted, can you remember a relief that was available when you made a gift? Can you remember a relief that was available when you made a gift there? So I'm hoping you're getting the idea that gift relief was available. And you may or may not recall, if you don't, go back and check it out in the CGT reliefs chapter, that assets that qualify for gift relief would include shares in an unquoted trading company. So although on the lifetime gift there may be immediate chargeability to CGT, that immediate chargeability in fact may be deferred through the availability of gift relief. But do remember, you don't get gift relief in CGT just because you give an asset away. You get it because the asset being gifted qualifies for gift relief, such as here, shares in an unquoted trading company. Now that's a little bit of revision about what you did in CGT. And again, if you're uncertain as to that, then you will have to go back and revise what happened there. In Chapter 26, we'll take you through various practical scenarios where you deal with multiple taxes, rather than just dealing with a tax, a single tax scenario, like we're used to, like do an income tax computation, do a corporation tax computation, do a capital gains tax computation. What we may see, and we discuss in Chapter 26, is practical scenarios like this. The taxpayer gives away assets to his sons and daughters during his lifetime. And they don't just ask you to calculate the CGT, advise on the CGT implications. They don't just ask you to advise on the IHT implications, as we're now starting to see here in this chapter. It is advise on the tax implications of that gift. And therefore, a gift in lifetime, if it is of a chargeable asset for CGT, involves capital gains tax there and then, and of course, whatever asset we're dealing with also may be exposed, not immediately, but a later point in time, to IHT. That this gift here to the daughter, if sadly A dies within the next 7 years, that will become chargeable. And if it does become chargeable, we will not be using as a chargeable figure the market value of the shares being gifted, that 200,000 that we just computed there, but we will be computing for IHT this, the transfer of value here. That is a very, very different figure. A Transfer of value will arise by the gift of an asset either in lifetime and or on death. For most taxpayers, as stated above, their only transfers of value will arise as a result of their death. Yeah, for most taxpayers, we're not in a position, unfortunately, to be able to give things away in our lifetime. We may need them, of course, to again survive for our remaining years. But in any exam question, you're going to be dealing with a client there who's rather better off than most, who is in that enviable position of being able to make gifts in their lifetime and still have sufficient, of course, to keep them in the way that they would like to be able to live for the rest of their lives. So, to repeat, in terms of purely inheritance tax, for any IHT to arise, there must be a transfer of value. That transfer of value is the loss to the estate of the donor. That difference between what he had before the transfer and what he had after the transfer. When made in lifetime, there is no immediate IHT liability. There will only be chargeability there if, sadly, the transferor, the donor, dies within 7 years of having made that gift. If you do die within 7 years, then those transfers made within the 7 years of death become chargeable as a result of death. We go back to the earliest transfer within that 7-year period, and we start to tax on a first come, first served basis. The transfer 6 years before death, before the transfer 4 years before death, before the transfer 2 years before death. The importance of that is the available nil rate band, that we do not start to pay tax at 40%, the main IHT rate, on all transfers made. We have to begin with an available nil rate band of £325,000. What that means, therefore, is that those lifetime transfers made will enjoy the use of that nil rate band on a first come, first served basis. The one made 6 years ago before death will use the nil rate band before the one 4 years ago, before the one 2 years ago. And all of them get to use the nil rate band before any that may remain would be available to go against the chargeable estate at death. The chargeable estate at death, what is that? It is a list of the assets held by the taxpayer at the date of death, less any debts and liabilities. So, the death estate, as we have said. On death, the assets owned by the deceased are valued and included in the death estate. We also take out, of course, the value of the estate will be reduced by any legally enforceable debts due at the date of death. For example, credit card bills, funeral expenses, and we'll reduce it by any exempt bequests. Exempt bequests, as you'll see here, one we've already mentioned, your spouse or civil partner there. There are others, but that's the only one that we need to be aware of so far as our syllabus is concerned. Couple of valuation rules to be aware of in terms of the death estate. A property is a usual part of that death estate, and if the property that is held by the taxpayer in the estate is mortgaged, then that mortgage will reduce the property value if it is said to be either a repayment mortgage or an interest-only mortgage. Again, you don't have to worry about what these terms mean, but if you were told that something called an endowment mortgage existed on the property, then that mortgage would not be deducted as they are repaid on death by the life assurance part of that mortgage. Now again, you don't have to know that. All you have to know is that if in the death estate there is a property owned by the deceased that was worth £400,000 and upon which there was either a repayment mortgage or an interest-only mortgage of £100,000. Remember, a mortgage there, sorry if you're not familiar with that term, you borrowed that amount from a bank or other financial institution to allow you to buy the property there. There's few people who can afford to go out and buy one for cash there. So we bought it by means of borrowing from a bank or building society, indeed, as we would know them in the UK, or any other equivalent financial institution. So if you've got a property worth 400,000 with either a repayment or interest-only mortgage of 100,000, the inclusion within your chargeable estate, 400 minus 100, the net value of £300,000, is included in the chargeable estate at death. If, on the other hand, it was said to be an endowment mortgage, then there is no deduction of the £100,000 mortgage. You would put a note to the examiner, if it's other than, of course, than an objective testing question, which it probably will be, to be fair, but if it was a written exercise there, you'd explain that the endowment mortgage there is not to be deducted from the value of the property in terms of computing the value to include within the estate at death. Okay. Other issues about content of the estate at death include the proceeds of any separate life assurance policy on the deceased's life. They'll give you two figures, most likely. That will be the proceeds, which is the figure you want, but they'll also give you the market value of the policy at the date of death. Now, you'd think market value at the date of death, that's what you'd include. No, it's the proceeds. So we're offered those two figures on a life assurance policy, on the life of the taxpayer. It is the proceeds that goes into their estate, not the market value. Okay, to sum up, therefore, when we deal with IHT, the usual circumstance is we're dealing with the death of the taxpayer. On the death of the taxpayer, two main IHT computations will be required. Firstly, the lifetime transfers chargeable that now become chargeable on death, only those made within the 7 years before the date of death. They are taxed separately and individually, going back to the earliest such transfer within that 7-year period. I trust by now you remember the 6 years ago, 4 years ago, 2 years ago lifetime transfer order. And we'll see that in terms of an example, well, what will be in our next lecture together on IHT. After and only having dealt with those lifetime transfers to begin with, and having therefore applied on a chronological, on a first come first served basis, the so-called available nil rate band, do we then, as a second and separate computation, list out the assets held by the taxpayer at the date of death, less any debts or liabilities due at the date of death, in what we head up as the chargeable estate at death. If the lifetime transfers in the 7 years before death did not exceed £325,000, then whatever remains of the nil rate band is firstly available against the chargeable estate. The balance of it will then be taxable at 40%. The amount of tax that is payable in relation to our lifetime transfers, and indeed the death estate, has got nothing to do with where those assets go to, the beneficiaries, the donees of any lifetime gifts. The amount of any tax that may be payable on any such transfer is everything to do with the donor. IHT is a cumulative donor-based tax. Okay, well, that's our basic introduction, so that we've set the scene in relation to chargeability to IHT. What we'll be able to do in our next session together is to look at the details of those lifetime transfers. What happens where we do make gifts 6 years ago, 4 years ago, 2 years ago? What happens then on death when it's within 6 years, 4 years, 2 years of the date of death? And how do we tax the death estate? And how do we apply that nil rate band there? All of that in exercises to be seen in our next session together.